There's a pretty consistent spread of about 250 to 300 basis points in a premium. And that premium just isn't simply about size. It reflects what scale enables, right? Which is denser operations, stronger management infrastructure, better customer acquisition strategy, and just overall more strategic relevance to buyers. But the multiple is often where the biggest value creation opportunity lies. You can't control where the market multiple is, but you can absolutely control how you position your business for premium multiples based on the KPIs and metrics that matter most for the buyer pool. Because these are really the two flywheel metrics of your subscription model. Conversions tell you how effectively you're adding members, while churn tells you whether the bucket is leaking faster than you're filling it. All right, next I want to focus a little bit on customer lifetime value. And customer lifetime value tells you how much revenue the average member generates over the life of the relationship. And it's a simple but powerful measure because it combines pricing, retention, and customer value into one holistic number. And it really helps to shift the focus from how many members do I have to how valuable are those members, right? I think a lot of operators, they get focused on just hitting, I want 4,000 members, I want 5,000 members. But this really helps shift that focus to what is the value of each individual member. And in general, the stronger the lifetime value, the more attractive the membership base looks to a buyer. Customer lifetime value captures things like revenue durability, right? So how long does a customer stay and how much do they spend? It's a really good measure of your loyalty strength. So understanding retention and satisfaction combined, as well as pricing power, right? It's the real value of your membership pricing strategy. So we have here a work example, which really provides some guidelines on what best in class should look like. Average recharge about $28 a month. And in general, we're starting to see the industry kind of move in lockstep, to increase their plan pricing. But I'd say, $28 a month is a really healthy target you should be looking at for your average monthly member recharge. With an average customer lifespan of 13 months, we'll dive into that here a little bit more in a moment. But you put that together, if your average monthly recharge is $28 a month and the average lifetime of your member is 13 months, that would suggest that target number should be around $364 for your customer lifetime value. Now, a lot of groups, as I have conversations around customer lifetime value is, well, this is great. I know my average recharge, but help me understand, how do I know what the lifespan is of my member? And, it's a good question. Lifespan is simply the inverse of churn, right? Churn is a monthly metric. So if you want to understand what your average lifespan is of your membership base, if you know your monthly churn, all you have to do is take one and divide it by your monthly churn. So example, if you're at that 7.5% mark, 1 divided by 7.5% would be 13.3 months. So that would suggest that the average lifespan of your member is in fact 13 months. Conversely, if your churn is lower, let's say in that 5% range, 1 divided by 5%, that would state that the average lifespan of your customer, your member is 20 months. And, I really want to highlight this because that means that just the smallest reduction in churn has a very, very meaningful impact in the economics of your business, right? If you can reduce your churn from 7.5% to just 6.5%, you see here the lifespan increases significantly. It's a material change. And that math compounds fast across a large member base. So the more units you have, the more scale and the greater the member count. If you start really honing in your churn and churn reduction, you can get really significant incremental and material impacts to the lifetime value of your customer base. And this is exactly the type of hidden value that buyers are modeling today, even if it's not obvious from, a high level P&L. So really, message here is don't chase the next car. Build the next 13 months of revenue. Focus on churn because that 1% reduction dramatically increases lifetime value, right? So again, going back to that example, if churn drops from 7.5% to 6.5%, that lifespan increases from 13 to 15 months. And you extrapolate that across, membership base of, let's say, 10,000 members, that's hundreds of thousands of dollars in enterprise value creation. So again, this is the math that every buyer is modeling behind the scenes, and definitely the metrics that you should be thinking about as an operator as you evaluate just the overall attractiveness and success of your business. All right, I want to pivot now to customer acquisition costs. And this measures how much does it cost to acquire a paying member here. And I think this is important, right? I think promotional efficacy is something that is not talked about a lot in the car wash business today. And in competitive markets, you may have, competition and car wash operations that are trying to bring customers over by way of promotion and promotion alone. And, in my opinion, that's a dangerous game, right? That's how you find yourself in the battle, race to the bottom. At the end of the day, you really need to understand what is the real acquisition cost of my customers and my members. And this should include really all direct and indirect costs tied to acquiring a new member. This includes digital ads, direct mailers, the price of the promotion itself, right? So if you're offering, let's say, a very slick 99-cent, first month entry point on a $37.99, unlimited plan, that'd be a $37 spend rate that should be factored into your customer acquisition cost. Your on-site signage, any commissions or incentive payment that you offer to your CSAs and attendants and greeters, as well as any sponsorships. Generally speaking, this is going to be a catch-all for all marketing spend. It does not include programs or general brand expenses. It should only focus on the marketing spend and the spend in general of getting a new customer and new member in the door. So growth without understanding your customer acquisition costs is dangerous. If you don't know what it costs to acquire a member, you don't know if your growth is profitable. And sophisticated buyers look at marketing efficiency with a very fine-tooth comb. They want to see discipline here. They want to make sure that the growth is sustainable they're looking at, and that you're not just essentially buying your members, right? Which a lot of operators find themselves doing. So let's say, again, a worked example here, and this will provide some guideposts in terms of where you should fall. Let's say you spend $8,000 a month. And again, this is an aggregate spend that includes digital signage, direct mailer, any promotional cost, commissions, sponsorships, $8,000 of that spend. Say over the course of that month, you spend, or you convert over 400 new plans sold. That would be a $20 customer acquisition cost. And again, this generally aligns with what good should look like here. But the most important thing here isn't necessarily just understanding customer acquisition cost. It's understanding that relationship between customer acquisition cost to customer lifetime value, because that really tells you what it costs to grow, right? CLV tells you what that growth is worth. Customer acquisition cost tells you what it costs to achieve that growth. Putting the two together really helps you understand your promotional efficacy. So you could run a promotion in a campaign that could add members to your subscription counts, but how much is it really moving the needle and generating long-term durable profits to your business? Maybe you run a heavily discounted promotion and you get a great adoption, but if it's a high churn promotion, this can be quite expensive to the business. So the one thing you really want to understand here is that relationship between your customer lifetime value and acquisition cost. In general, if you're, 15 times greater from customer lifetime value or acquisition cost, you have a very scalable, profitable growth engine behind you. And this really means that every dollar you invest in marketing produces predictable returns. And that is the difference between growth that consumes cash and growth that creates value into your business. So again, I think it's really important for operators to understand not just the lifetime value of their membership base, but the customer acquisition cost, and understanding, again, is the growth of my membership base sustainable and profitable? All right. Next factor I want to talk about here would be revenue per car, often referred to as RPC. And really revenue per car, it captures a mosaic of different factors. And I think, one caveat here is we get, asked this a lot, where should my revenue per car be? It really depends on your local market dynamics, to be honest. Mentioned before, I operate in Chicago. Chicago has historically been a $3 car wash market. Okay. We are aggressively trying to bring our pricing up to where national averages are. But you really need to kind of think about RPC in the context of brand perception, pricing power, and local market dynamics. Higher RPC usually means customers see value in your premium offerings. It's a signal of pricing strength, brand positioning, service quality. But really, it's again, you have to understand it in the context of your local market dynamics. It also brings in and reflects membership mix and pricing strategy, right? So the more membership counts you have, the greater the usage of your membership programs. You generally see a decline in RPC. So there's a lot you can learn there in terms of optimizing pricing, not just on your menu for single washes, but your subscription washes, and making sure that your members aren't overusing and understand that drain on your revenue per car. But in general, as we look at kind of what best in class looks like, if you're in a value/economy market, again, I often think about Chicago as being squarely in this market. Typical RPC is at $9 to $11 range. Conversely, if you look at kind of mid-tier suburban with a balanced retail membership mix, you tend to see revenue per car in that $11 to $13 range. If you go to premium high income areas, and a lot, Florida is a really good example. Certain markets in Florida, Tampa, good example here. You see strong premium plan pricing, high perceived quality. You could see revenue per car up to that $13 to $16 range. But again, really important to understand and review in this lens of RPC, because you could learn a lot from it. You could understand, again, the overall membership mix and strategy and whether or not that's effective in driving economic performance at site, but also understand the dynamics in your local market to optimize pricing. So revenue per car, certainly something that's worth evaluating, but also evaluating it relative to your peers in your local market to ensure that you're hitting levels that are optimal based on the market you operate in. On the topic of understanding the relationship of revenue, want to talk about labor as a percentage of revenue. And I think labor efficiency is something that's really important. Most operators, if you look through your profit loss statement, labor is the largest variable cost in most car wash models, right? Small changes in labor efficiency have a significant impact on EBITDA. Every 100 basis points of inefficiency can translate into a significant loss in enterprise value at an exit. So buyers will look at labor not just as a cost line, but as just evidence of overall operational discipline and management quality. Well-run labor model signals that a business is scalable and controllable. So I would definitely not sleep on these metrics here. Labor as a percentage of revenue, we'd say best in class is at 13 to 16% range. That would have optimized scheduling, tech-enabled labor management, strong demand forecasting. I just love having conversations with groups and how they approach their scheduling and labor models. You hear a lot of different interesting ways to be thinking about the deployment of labor and how to better match labor to your demand. And that's definitely something we see, some of the best operators in the country is really efficient labor. Conversely, numbers that would suggest you need to improve, let's say you have a static schedule, you're really not matching labor deployment relative to the forecasted demand of your business, north of 20% would suggest you probably have some fat in the P&L. But one important thing here, again, you have to think what's in the context of the store vintage too. A sage operator once told me, never look at a P&L in the first year of your operation. You can make some bad decisions, right? So for example, if you're trying to manage a ramping store with $1 million in sales to a 20% revenue target, you're probably going to have to pull back your labor significantly, which will ultimately deteriorate that customer experience in the long run. So, a little caveat here, everything we're looking at is in the context of mature, stable store performance and how to understand labor as a percentage of revenue for some of the best in class operators in the country. And that number, again, falls in that 13 to 16% range. All right, looking at a different view of how to think about labor here, two metrics, employees and cars per labor hour. So employees per labor hour tells you how many employees you have per every labor hour on site, where cars per labor hour tells you how many cars each employee will process, right? So EPLH tells you how many people are on the clock. CPLH tells you how productively they're being deployed. And, you really need to understand both metrics together. They're in isolation. High staffing density with weak productivity is one of the clearest signs of margin leakage. And this is where a lot of sophisticated operators separate themselves. They understand demand patterns and staff to them. Interestingly, I was in Florida probably about 2 to 3 years ago. Really, beautiful car wash, express car wash. It was Wednesday afternoon, so not a tremendous amount of volume. There are maybe, 2 cars in the pay lanes, 1 car in the tunnel, 4 or 5 cars in the lot vacuuming. And as I was looking across the store, I counted two employees at the pay stations. There's a loader. They had 2 employees floating across the lot and 1 employee just kind of sitting around in the lobby of the car wash. And I asked the store manager, hey, how many employees per labor hour are you averaging? And he looked at me like I had 3 heads. Came back 2 days later, sent me an email, hey, you asked the question, want to look into it. We're at about 7 employees per labor hour, right? So it's really important to understand kind of how you're staffing, how many employees you have on the clock relative to that bell curve of demand, which is incredibly relevant in car washing, right? We all know that bell curve where you start with your early morning, maybe a little commuter traffic here, but generally speaking, your volume is lower. That tends to pick up as you kind of move into the evening commuter hours, which will then taper off as you move into closing. And that's why it's also really important to understand cars per labor hour. Some good benchmarks for both. You want to have about, on average, 3.5 employees per labor hour. And this would reflect, again, not static scheduling, but matching your employees per labor hour to just the needs of the business. Maybe you open with 2. They could do all of your pre-opening routines. You bring that 3rd employee in, mid-morning, 4th employee in ahead of the afternoon rush, maybe bring in a 5th to offer some backstop support. And you move into your closing procedures. You start to pull employees back. In average, you're at 3.5 employees per labor hour. Conversely, as we talk about cars per labor hour, again, anything greater than 12 is a pretty good number here. So based on, the number of employees you have on site, let's say you have 4. If you're at 12 cars per labor hour, that would suggest that your volume's at about 48 cars per hour. Once you start breaching, it's not on this slide, you want to be greater than 12. But once you start breaching, 30 cars per labor hour, at that point in time, you may want to start reviewing, hey, do I need to put more employees on site? Because that could put a pretty big strain on throughput if you're not properly staffed to manage that volume. So it's not necessarily, getting that number as high as you possibly can. It's really straddling between that 12 to 20 cars per labor hour range here that's optimal. But as mentioned here, it's not just about labor efficiency and utilization just to, pull back staff and, not waste payroll dollars. It's about managing and aligning labor to the demand of your operation and optimizing throughput, right? So managing scheduling and forecasting, having cross-location benchmarking too. I love incentivizing managers to this and understanding kind of which managers are better and more proactive in their scheduling versus managers that maybe are wasting a little bit more. But overall, understanding that relationship between cars per labor hour and employees per labor hour and just revenue as a percentage of sales helps you improve productivity, helps you match labor to the demand of your operation. Even a 1% to 2% swing in labor percentage, given how much you spend, can materially impact EBITDA. So again, it's not about cutting people. It's about scheduling intelligently and understanding what my metrics should be. Sophisticated operators often align labor with their traffic patterns, and that discipline translates directly into margin expansion. So as we look at kind of what's ideal here, just from an example standpoint, so you have 5 employees on the clock, you're washing 100 cars per hour, you're at 20 cars per labor hour, your sales are about 14% labor's percentage of sales. That tells you have the right people, the right time, productivity is high, and labor cost is low. That's optimal. If you look at this, let's say morning lull as compared to the commuter rush, let's say you have the same static scheduling, you have 5 employees on the clock, but you're only doing 40 cars per hour. That would suggest 8 cars per labor hour. You see your labor as a percentage balloons out to, north of that 20% mark, which would suggest that you have, the same staffing, which means half the demand, and EBITDA leakage, right? That's a big problem because every operator should be focused on kind of margins, margin control, but more importantly, how do I better manage my labor to align it to demand, delivering this exceptional customer service, but doing so in a way where I'm not introducing too much bloat in my P&L. All right, next I want to talk about trade area factors that really drive the multiple here. We talked a lot about different KPIs and metrics, and I want to talk a little bit about some of the non-quantifiables from a KPI perspective. I think, one of the most underappreciated drivers of valuation in the car wash sector is just the general area, the trade area, and the quality of the trade area. Going back to what we're seeing today in terms of drivers of consolidation, I talked a lot about discipline and kind of fundamentals being important today, focusing more on quality over quantity. A lot of that is relevant in trade area dynamics here. So really understanding trade area quality, buyers look closely at things like household income, commuter patterns, your site location. A lot of these buyers will prefer that you are on the right-hand turn on the commuter pattern coming home from the highway. Really understand competitive white space, population growth dynamics, but strong trade areas support better membership mix, higher RPC, and just overall better growth visibility. And again, having more growth in the business equates to a premium multiple. So definitely understanding the trade area drivers and the dynamics of your platform is certainly important here. Weak or overcrowded trade areas. So let's say you're in a town, median income is 60,000, you have 30,000 people and 5 express car wash tunnels. That could compress pricing power and reduce underwriting confidence and overall have a significant impact to your multiple. So you can have some of the best KPIs, but again, if you're in a trade area that doesn't have some of those markings of what would be considered attractive to a buyer, portfolio quality is ultimately built by, site by site. Making sure you have those attractive markings are certainly, important consideration here. And with that, also understanding kind of regional trends in white space. Looking back at what we're seeing, just so much activity today, the Northeast and Mid-Atlantic is a great example. These are geographies that are, generally speaking, tough for entitlements, landlocked, not a lot of competition. You have a lot of good density within those markets and geographies. So as a result of that, we're starting to see a lot of interest, again, in the Northeast, Mid-Atlantic, out kind of in Southern California, even the Chicagoland market. So again, really important because not all growth markets are created equal here. So as we bifurcate kind of the country across 4 regions here, Southeast, as area remains highly developed, still attractive. You have some pretty good secular drivers with population growth within the Southeast. But as you look at, states like Florida, Georgia, you're starting to see some really competitive markets there. Tampa is a good example of having a highly competitive market. If you look across the broader Atlanta MSA, definitely some high quality operators there. But again, the geography itself is supported by population and migration. So certainly, attractive feature for the Southeast. Conversely, if you look at Texas, competitive market, you have a lot of scaled operators there. So as you look at some of the kind of the major metropolitans, such as the DFW marketplace, really kind of, a lot of competitive intensity with the likes of, Quick Quack growing aggressively within market there. You're starting to see, more selective suburban and secondary markets offering opportunity there. But Texas, really some great at scale operators that are driving consolidation in that market today. So look at the mountain Southwest regions, these regions continue to attract interest based on, emerging demographics and growing retail corridors. Some similar markings to what we're seeing in the Southeast there. As you think about is Arizona, you have, Cobblestone and Superstar, who are 2 behemoths. Nevada, you have Wild Car Wash. It's a big player out there. Utah, Colorado, again, a lot of, attractive features, certain subsets within the mountain and Southwest. You're finding, higher competition, but you do also see some attractive expansion zones, with Utah, Colorado, et cetera. And then finally, I've already talked about the Northeast Mid-Atlantic here. Remains comparatively underbuilt, pretty big gap here in terms of meeting consumer demand. So that's creating some really interesting long-term white space opportunities. I think a lot of the buyer groups today are really focused on that region in particular. But again, point here, we can talk about operational KPIs, trade area, geography still matters a ton in this business, and it matters a lot. All right, to round out here, I just want to talk a little bit about what top quartile operators do differently than most. If we talk about, platforms that we have transacted that sell at a premium versus, that may sell at a discount, a few habits show up over and over again. First and foremost would be relentless KPI tracking. The numbers are reviewed weekly. They're actively managed. And frankly, it becomes really the culture of the organization. I will tell you the performance of my business changed substantially once I gave my teams optics in terms of the KPIs that aligned their performance with the overall performance of the business. Use the adage all the time, you cannot manage to what you cannot measure. So I think some of the best operators in the country are those that track relentlessly to KPIs, and they align their teams to performance that tie to those KPIs that they're trying to hit. Second is really a true membership culture. Conversion is owned at the site level and really incentivizing teams to aggressively build the membership base. Third, commitment to maintenance. I cannot tell you how many groups that we see trip up as they scale their operations around their maintenance infrastructure, right? If you deviate away from that golden 80-20 rule, in which 80% of just your routine and preventative maintenance is on site with your GMs and your site level employees, as you start to deviate away from that, as you grow, you find yourself with this massive cost center in the business. So I think having, commitment to maintenance and appreciation and infrastructure that could support maintenance, and having an on-site culture that appreciates the virtues of well-maintained facilities, this is super important today. I'm telling you right now, deferred CapEx always shows up in diligence, and it's becoming increasingly important for the buyer pool. So definitely don't want to sleep on the fact that having commitment to maintenance is critically important today. And then fourth, professional financial reporting, having clean books, having a disciplined close process, having a quality of earnings ready of information, that's pretty important. A lot of operators still will just get P&Ls annually through their CPA for tax returns. Better to have clean books with more frequent, visibility, and having a really strong financial muscle in your business that you can layer some KPI reporting over. I think this really kind of ties in that first point with relentless KPI tracking, but having professional financial reporting that you can layer insights over, definitely a differentiator for top operators. So, even if you never want to sell your business, building the business this way creates optionality, and optionality is king. And there is certainly a price for having that optionality in your business.
Stay tuned for part 3 airing next week, where the discussion continues on another exciting episode of Behind the Business. Till next time.